Hey everyone, it's Aaron. Today I'm not super thrilled because I just found out about an infrastructure bill clause that has regulation for cryptocurrency taxation. Way more scrutiny, way more reporting requirements will be applied to the exchanges that we trade and hold our crypto on so that the government is now fully informed of your trades and any potential for profit or loss by the end of the year. Now, this is in place for the stock market as well. Any brokerage you go to is required to send forms off to the government so that when you report on your taxes what your gain or loss is, they make sure that it matches up. So I get that it's fair because they want people to report their taxes. But due to the unique, cool nature of cryptocurrency, we get to move our stuff around a lot more. You don't transfer a stock around from E-Trade to TD Ameritrade to Robinhood as much as we do with crypto. You know, you want to buy an altcoin, you got to buy from fiat to Bitcoin or Ethereum and then into that altcoin. You can't just go straight. And that's what the government didn't fully realize, I guess. And now they have created a law that's going to take effect in 2022 that if we don't pay attention, it's going to cause our profits that we have for the year to really be eaten into unnecessarily. Obviously, this is a tax situation, so you need to consult a tax advisor, and I'm not trying to give tax advice. But what I am is an investor, an enthusiast who wants to help guide you guys to find the right areas to look at to make sure that you're maximizing the profits that you work so hard for. And now we have more hurdles to jump over, but I'm here to guide you through them. So go ahead, smash that like button because it allows YouTube to show this video to people who are involved in cryptocurrency in any capacity, because we have to make sure that starting not only just in 2022, but even in the end of this month, December of 2021, there's moves we can make to ensure that we're setting ourselves up for success once it comes tax reporting time. All right, so hit that like button and let's get started. All right, let's take a look at this first article I want to highlight. Now, it's a bit of a long article, so I'm going to summarize the key points, which is in essence the thing that you have to be aware of anyway. And I'll put a link in the description below to the article so you can review it in detail. But here's the main point. So first of all, cryptocurrency tax compliance has historically been poor, but the government is trying to get better at collection. So a controversial section of the infrastructure bill signed into law by President Biden just on November 15th requires brokers, such as cryptocurrency exchanges, to issue Form 1099-Bs to customers for the 2023 tax year. And regulators believe that these forms will improve third-party information reporting by exchanges, making it easier for taxpayers to file taxes and ultimately lead to improved compliance. Unfortunately, lawmakers have overlooked several intricacies unique to crypto in drafting this provision. Not considering these crypto-specific situations, decentralized finance, transfers, and self-custody could make 1099-Bs entirely ineffective and create unintended tax nightmares for taxpayers. What are 1099-Bs? Well, Form 1099-B is a proceeds from broker and barter exchanges. And that's a form filled out by those brokerages to summarize a customer's annual gain or losses subject to taxes. And there's 3 copies distributed, copy A, copy 1, and copy B. Copy A and 1 are filed with the IRS and the state by the exchange. Copy B is sent out to the customer before he or she has to file their taxes. For example, let's say you purchased 1 unit of Tesla for $500 and sold it for $1,200 on Robinhood at some point during 2021. By January 2022, Robinhood is required to fill out a Form 1099-B showing a $700 gain, capital gain, subject to taxes. So copy A and copy 1 report that amount to the IRS and the state, respectively. You receive copy B to help file your taxes. So what we're saying here is, this is a basic thing that happens in the stock market or with stock exchanges, and it's normal. But now we're about to get into why it's going to be problematic for crypto, and you need to be paying attention. The IRS document matching program. So 3 copies of the same 1099-B exist to support with the IRS computerized document matching program. With that example above about Tesla, if you somehow don't report that $700 capital gain on your taxes, the program will automatically flag that return and send you a tax notice to correct it. This is because the IRS believes you have underreported income by $700. And that's because Robinhood reported it to the IRS that you had $700 worth of capital gains that don't appear to be reflected on your tax return. The matching system combined with an independent third party, in this case Robinhood, also could be Coinbase now, right? Reporting your activity directly to the IRS is designed to ensure that taxpayers pay their taxes on capital gains. The above reporting, which has been required for ordinary stock brokers for a decade, is working extremely well for them. And then it goes on to talk about how when they report the 1089B, the non-compliance for filing your taxes and reporting that income is pretty low. And so what regulators tried to do was replicate that system in crypto by having brokers issue the same 1099B starting January 1st, 2024 for the 2023 tax year. Unfortunately, the language included in the final bill didn't take crucial crypto-specific intricacies into account. So although a 1099B has been effective when it comes to improving non-crypto related tax compliance, it's going to fail in crypto and cause unfavorable second and third order consequences to us, the taxpayers. So basically what the article is saying here in this section is, there's a lot of decentralized exchanges like Uniswap or DYDX, and they'll be unable to issue a 1099B because they're not collecting any know your customer information like your name, address, social security from users. And this information is required to file those forms. Second, asset transfers between wallets and exchanges are very common in crypto compared to traditional securities world. These transfers between the centralized exchanges to or from DeFi and non-compliant overseas exchanges will lead to incomplete 1099s, causing more issues for taxpayers. So let's take a look at this really crucial example. Say you purchased one ETH for $700 on Uniswap. You later moved that coin to Kraken and sold it there for $1,000. Now Kraken will issue a 1099B showing you sold an Ether for $1,000. It will not show the cost basis of $700 because it doesn't know how much you paid for the coin in Uniswap. And $1,000 reported to authorities instead of $300, which is your real gain, could cause problems to taxpayers down the road. And then third, self-custody is common in crypto world to ensure privacy and security of assets. Self-custodied assets will also make it harder for exchanges to issue a complete 1099B. For example, you purchased one Bitcoin for 30 grand several years ago. This is securely stored in your Ledger hardware wallet, but in 2021, you sent this coin to Coinbase and sold it for $50,000. Here, you could rightfully owe taxes of $20,000 on capital gains. However, Coinbase would report $50,000 on the 1099B because it doesn't know the cost basis of the Bitcoin transferred in from your ledger. So this is the main issue, that your cost basis, if you move crypto around, and $10 says if you're really involved and not just hodling on Coinbase or something, that it's going to be a problem for you because the cost basis will not be tracked from exchange to wallet, back to exchange, so on and so forth. Now, you obviously will report it on your own, but we'll get into a second and third order effect here regarding that. So incomplete 1099Bs with missing cost bases will confuse taxpayers. And an uninformed taxpayer will overreport income and overpay taxes if they rely on these incomplete 1099Bs. They will blame exchanges for reporting incorrect information. As a solution, taxpayers will have to use third-party software to reconcile their activity across multiple exchanges and wallets to arrive at the correct capital gains. Now, it's great, and it's you're being honest, keeping track of stuff, but here's where it's still going to be a problem, unfortunately. However, these reconciled capital gains or losses would be different from what has been reported to the IRS and the state by the exchanges through the 1099Bs. These mismatches could trigger the IRS document matching system and lead to troublesome tax notices, which could be time-consuming and expensive to resolve. So, basically, the article goes on to say, if you're using one exchange, it's not going to be a huge problem for you because if you're buying and selling all in the same exchange, then the exchange is going to be able to report that information correctly and track that cost basis for you and send it off to the IRS. And when it's the same as your cost basis, hopefully it's very unlikely there'll be a trigger in the document matching system, which is great. But what this is saying is if you're very active and you're moving things around, then unfortunately you're going to have probably some really detailed paperwork and maybe the help of a CPA to handle a notice that could come from the IRS. But they're not telling us this in a broad perspective. They're not telling us this now so we can get our minds right, get our trading strategy set up. Maybe you want to move money around to other exchanges so that you can stay centralized. I know, ironic, right? But stay centralized on multiple exchanges. Maybe you have money on different exchanges to perform different strategies. Maybe you're staking on one, maybe you're trading on another and holding on another, so that when you trade or when you sell finally, you can have that accurate cost basis calculated and sent off to the IRS to match what you're going to put in your tax return. So it's very key. Now again, I'm not a tax advisor, and so I can advise you to consult a CPA or other tax advisor. But this video is really to identify a thread for you to start pulling on to make sure that you do the right thing, not only in the short term, but again, like I said, we've got to set up our mindset, our trading and investing strategies, and get that infrastructure in line in the right tax year so that you can set yourself up for success. Because, if you never knew about this and then you hold something for a very, very long time until you have massive gains, 5, 6, 8, 10 years later, you sell, it's going to be super out of whack when it gets reported if you didn't set yourself up now. So what do you guys think? I wanted to highlight that one key thing that came out from the infrastructure bill regarding cryptocurrency taxation that we all need to be aware of. So I hope you have more time to spend on this, looking into it to make sure you're set up and getting set up now in December of 2021 so that everything's straight, ready to go starting in 2022 once these reporting requirements kick in, so that in the out years, in 2023, if you sell when the reporting requirements really start, then you'll be ready to go. So go ahead, smash that like button. Hopefully this video can get to more people who want to make sure that they have the right reporting requirements in their mind when they're setting themselves up for a trade or an investment, and they get to maximize their profits that they work so hard for. So consider subscribing. I'll be doing more videos specifically on this topic in December. And hit that like button. I appreciate you watching. I'll catch you next time.